I feel like once I hit $2 million, I'll be able to retire. And I say to them, it's not the dollars that's going to make you successful in retirement. It's the cash flow. It's the income. It's the consistency.
I think money more so can be along that stressful line. Thinking about that in retirement even can be a little bit more scary.
The IRS looks at that and says, Kamie, you've never paid tax on that money. We are now going to force you to start pulling money out. Whether you want the money or not, you need to pull money out.
Just explain how someone can go about finding the right person to help them with their finances.
If you've got family or friends, ask them who they've recommended. When you've either found someone that either your neighbor or friend, maybe a relative recommended, go meet with them. Welcome back to another episode of Retire and Thrive, the podcast where we help you live your next chapter with purpose, wealth, and confidence.
Thanks so much for joining us this week. I am Kamie. This is Dan. He is our financial expert. And this week we are talking about different incomes you need if you are in that retirement phase. So 3 incomes all retirees need. Let's talk about it.
That's a lot.
That is a lot when you think about it. But when you think about retirement, in my mind, there's a lot to think about and all sorts of different income streams that you'll be pulling from.
Right. And if you remember, this episode is about cash flow. We touched on it last week where we kind of scratched the surface about the cash flow and the importance of, ended up diverting a little bit, which we can tend to do about budgeting. But it all ties in together. And so this time I really want to spend time kind of diving into the 3 different types of incomes for retirees.
So when you have someone that is hitting that retirement age, say it's a client of yours, we'll say hypothetical, what is the first income that you touch on?
Well, the first income that we touch on is what are the guaranteed income sources? And I mean, in our world, we don't like to use the word guarantee, but maybe a better definition would be what are the secure income that's coming in consistently regardless of what happens in the economic world, be it the stock market, bond market, any of that. So yeah, that's what we look at is what's the income that's coming in every single month regardless.
Okay. So we're touching on Social Security. We're touching on your 401k, other sources of income that you have. Maybe you have a rental property or you have real estate that you've invested in.
Right. Yeah. I don't know if I would include the 401k in there because again, Kamie, some of that can fluctuate.
Yeah.
No, it's okay. But you're right. I mean, that includes everything from Social Security. And I know you and I have maybe talked a little bit offline about this because you had asked, do you really think Social Security is going to be around when you retire? And while I don't know that for certain, what I do know is that if somebody's retiring in the short run here, very confident that Social Security is a good source of income.
So how does that work when someone gets to the retirement age? What is the next step that they would take as they look at their Social Security?
I feel like you've read the book so much, you already know that that's one of the lessons is Social Security, but we won't be touching on that for quite a few episodes in the future. But if you want, we'll just chat on it real briefly.
Yeah, just briefly when you think about it, because folks that are maybe in their 50s, into their 60s, getting to that retirement age, they're looking at all this money they've put into Social Security. You can look it up online and see where you're at. Well, how do I get that money?
Yep, it's a great question. So I'll be very brief, which sometimes can be a little bit challenging, but I know we've got other things we want to talk about today. Social Security, first thing that you need to understand is the window to take Social Security is from 62 up to age 70.
Okay.
And so that's the first year. The first year is at age 62 that you become eligible to start receiving a benefit from your Social Security. Every year that you delay it until your full retirement age, which for me is 67, that's the longest. You know, people that are, in their mid 60s now, their full retirement age might be 66, 66 and a half and so forth. But for every year you delay Social Security from 62 until your full retirement age, it actually increases, Kamie, by 7% a year.
Okay.
So think of that for a minute. I mean, you've got an income that potentially can grow by 7% a year.
If you can extend, yeah.
But you have to defer it. So then there's that trade-off. If I defer it, that just means that I'm not going to get it.
Sure.
So we run some analysis that kind of has what we would call kind of a break even. And again, this is not a universal thing, but in general, taking it to 62 versus full retirement, oftentimes we find that break even is like 82, 83 years old. In other words, for every year you live beyond 82 or 83, you actually are better off waiting and taking it until full retirement.
Okay.
And then just something that a lot of people maybe aren't aware of is if you delay your Social Security from full retirement up to 70, it actually grows by 8% a year.
Oh, wow. Okay.
And think about it from the government standpoint. That's money that they're not paying out.
Right.
And so they're encouraging people to wait.
Sure. Yeah.
But if you've got great health, you've got other income sources, lots of other strategies. So how do I supplement that? Maybe it's some of your retirement. But yeah, so that is one guaranteed income source is Social Security. Guaranteed in the sense that as long as Social Security continues to pay, it shows up in your bank account every month and you don't have to worry about it.
Yes. So guaranteed, we're going with the income that you likely will be getting. What is income number 2 we're looking at?
I think the other one, and you brought it up a couple episodes ago, and it's pension income. We live in a town here in Rochester where we do have employers that do offer pension plans. And for those of you that maybe are younger and maybe aren't quite as familiar with pension plans, it's literally like you work for a company for so long, Kamie, and they just give you a check when you retire. It's nothing you have to do. You don't have to contribute to it. It's not like a 401k or 403b. Kind of a fancy name for it is called a defined benefit plan, as opposed to like a 401k or a 403b is called the defined contribution because you're contributing to it.
Sure.
But yeah, so we have clients of ours that are about ready to retire. We look at that and, sometimes it becomes a little bit overwhelming because they can take a monthly income, they can take it on their life, they can take it on their spouse's life, or if they pass away, their spouse is going to get 100% of it or 50% survivor benefit. And so it does get a little bit complicated because all too often, I know, at least for me, if I go to a restaurant and there's too many choices, then I go, then I'm paralyzed, right? And we see that where people are just like, I don't even know where to begin on this pension thing. But we always look at it and say, look, this is a beautiful thing that your employer is rewarding loyalty. And that check comes in every single month. So that's the 2 main ones that I look at when I think of guaranteed incomes. I think real estate can fit into there. And part of the reason is that if you've got rental property, be it a commercial property or a residential home, and you've got long-term renters in there, that can be another source of income that we look at as fairly consistent.
Yeah, pretty stable there. All right, next up, we're talking about variable income. So obviously, it sounds like there's some and ifs or buts in this income. What more can you tell us about this for our retirees?
So this isn't really rocket science, but if we're talking variable income, it does vary. I'm joking.
Well, sort of you are, but
it's true.
It's true.
And so I think when we look at variable income, a big part of that is income that changes year in and year out. And so when we look at investment portfolios, a lot of the stocks in these portfolios kick out dividends, and those dividends are not the same every single year. And so if you've got a basket of stocks or an investment portfolio, some of those stocks may pay out more this year. Some of them may go into challenges where they have to reduce their dividend. So that would be one is dividends. The other thing is investments. Typically your mutual funds pay out something referred to as capital gains. And capital gains are, if this mutual fund has 500 different companies and they ended up selling 40 of them and they had gains, oftentimes they don't pay out those gains till a certain time of year. It could be at the end of the year, it could be in the third quarter, but that varies widely year after year.
Okay.
And the other one that I would probably say fits into that category for people that are older and in retirement right now at age 73, any retirement accounts that you have to take something called a required minimum distribution.
Okay. You do. That's that age. You have to.
Yeah.
Once you're that age. Okay.
So we just call it RMDs. And again, think of it from this standpoint. If you're putting money into a 401k at a younger age, what happens is if I put in $2,000 a year into my 401k and my income's $80,000 and I put $2,000 in, I get to reduce my income by that $2,000, right? So it's considered pre-tax. In other words, if I make $80,000, I put $2,000 into my 401k and I only have to pay tax on $78,000. I'm oversimplifying it here. But in essence, Kamie, I've never paid tax on that $2,000 that goes into my 401k. And you do that over time, and I'm using fairly simplistic numbers, but just imagine if you're making $100,000 and you're putting in $20,000 a year. So you go to retire and all this money is pre-tax, and at 59.5, you can start tapping that money without the IRS's 10% penalty. But I know we talked about this before too. That income is treated as regular or what we refer to as ordinary income. But if you've done so well with your finances that you've got pension income and rental income and Social Security and you got $1 million 401k, you might be like, Dan, I don't need that. So I don't want to pull any money out. Well, fast forward till currently age 73. That does change, not to get too granular here, but in the year 2035, the current law states RMD is going to be pushed back to age 75. But for now, it's 73.
Okay.
But here's the point. At age 73, if you've never touched that money, or even if you have, whatever your balance is, the IRS looks at that and says, Kamie, you've never paid tax on that money. We are now going to force you to start pulling money out. Whether you want the money or not, you need to pull money out. And so what they do is they take a snapshot value at the end of the year, December 31st, and then it's a formula. And that formula is every year you get older, the percentage you have to withdraw becomes a bigger and bigger percentage. So that's variable because you don't know whether your required minimum distribution is $3,500 or if it's going to be $5,700. And that varies from year to year. So hence the name variable income.
Okay. Next up, what do we have here? Flexible income. Flexible income. All right. Tell us more about this.
I told a story, get my episodes mixed up here, but it was either last episode or the episode before where I had clients that actually went to their banker and took out a home equity line of credit, and then they were able to use that when the market was down. And so to me, that's a flexible income source.
Sure.
I mean, it's not anything that is variable because it's a source that you can use. In their particular case, they used it to pay the contractor because they didn't want to take it out of their portfolio when the markets were down. So that to me would be a source of flexible income. Another one would be cash reserves that we had talked about earlier too. So that's another source of flexible income.
Okay.
And I want to clarify too that, when we look at these three types of incomes and we start with the guaranteed income, and that's kind of where everything starts. And then from there, we go to the variable income, and then it's the flexible income.
So when you look at that, do you work with clients with these three?
Absolutely.
You talk about these three. What is the most difficult for clients? Guaranteed sounds great because we know we're getting that. Variable might sound great because it might be a lot more money than you expected, or it could be worse, I suppose. Yeah. And then you have your flexible income, which is maybe somewhere in between. What is the most stressful part? What is the hardest part for retirees to grasp?
I would say the variable for sure. The flexible income, think of the flexible income as more as if I need it, it's there, right? Kind of like we talked about that emergency fund. Or
that's
HELOC
kind of what it is. Yeah.
But it's kind of fun is when we build these plans out and we look at that guaranteed income. And again, I'm going to go a little easy on the word guarantee, but it's the consistent income that doesn't change. There might be a little increase in Social Security. Some pensions go up a little bit.
But you'll be getting some money there.
Right.
Yeah.
And very seldom have we ever seen a situation where pension dollar amounts have gone down or Social Security's gone down. So what we do in our plans is, again, we talked about the budget and how important the budget is. But once we dial in the budget and how much income that they need on a month in, month out basis, and we start factoring in these income sources, specifically that guaranteed income, it's really eye-opening for people to see because it's not that unusual where we start factoring in, a husband and wife, and maybe they both had pensions and they both get Social Security, and that might be 90% of what they need to live. And so just that alone is more than, between the Social Securities and the pension, that, like I said, might be 90%. And all of a sudden they got this large portfolio of retirement assets. And again, not to go into the weeds on this, but age 73, because they haven't really needed the money, they're going to be forced to pull that money out. And they're like, well, oftentimes we'll hear them say, we don't need the money. And I'm like, I'm sorry, you still have to pull it out because the government doesn't care because they want their tax revenue.
Right. Absolutely. Yeah.
So I would say that the guaranteed income is really fun because we can quantify what percentage of their guaranteed income covers their overall living expenses. And what we notice is that when people retire and we build that out, they'll look at that and it's just like, what peace of mind is that? Knowing that 90% of all of my expenses are covered because of the check that comes in my bank account every single month.
And I'm sure you deal with many clients, maybe it's even friends or loved ones that come to you with advice. Many folks concerned, maybe worried that they haven't done this right. They don't have the money that they thought they did. And I think a lot of times it sounds like they come to you and you find some different areas that they've forgotten about. Is that true?
Yeah. There's a lot of different scenarios that we look at. And so I think it's not so much about, because I hear the question, I feel like once I hit $2 million, I'll be able to retire. And I say to them, it's not the dollars that's going to make you successful in retirement. It's the cash flow. It's the income. It's the consistency that comes in the door. In fact, we had someone in here just a few months ago, and they were ready to retire, and they were almost embarrassed at how much they hadn't saved.
Okay.
And they were 60 years old, had a very high income, and they're like, I've only got like $400,000 in my 401k. So we built out, what their budgets were. We built out the whole plan. And what they didn't realize is between their pensions and the Social Security, they had more than what their budget was. And I know I kind of did the math before, but I think it's appropriate. I'm going to do it again. So if you've got a consistent Social Security and you've got a consistent pension, and I'm going to just use a number of, say, $60,000 a year. If you're getting that $60,000 a year, and we talked about that sustainable withdrawal rate of 4% a year. And so if you've got a portfolio of $1 million and you're pulling out 4% and it's invested properly, that's generating $40,000 a year for you. But imagine if you had a pension and a Social Security that combined, whether it's you and a spouse or just yourself, if you had a combined $60,000 coming in between pension and Social Security, if we reverse engineer that and say, if our sustainable withdrawal rate's 4%, what would I need to have in a 401k to generate $60,000 a year? And if you do the math, it's $1.5 million. So think about that for a minute. You have a choice of either having $60,000 a year coming in every single month or every year, or $1.5 million portfolio. So when this guy came in and says, I've only got $400,000, I'm like, hold on, don't get discouraged here, because you've got a very high income coming in from these secure sources.
Sure. Yeah. So looking at all those different income streams. All right. So we have our 3 types of income that you should consider and look at if you are in that retirement age. Anything more that you'd like to touch on?
I don't think so. I think, again, I just kind of reiterate to those that are approaching retirement that you don't solely focus on the dollars. Because again, the 401ks, the 403bs, all of that is an asset. And you don't live on the asset, you live on the income that the asset generates. And when we talk about those guaranteed income sources or those secure sources, that's replacing the asset that you don't have to have. And so oftentimes I think as consumers, we focus on our net worth, and that's the most important thing. But it's really about the income.
Yeah. What's coming in. All right. Since we have a little bit of time here, Dan, I wanted to touch on, someone commented on one of our previous episodes about having a financial planner. We've touched on it briefly, and I know you find it to be very important to have someone in your corner helping you with your finances. The person commented and they were wondering, well, how do I even do that? How do I go about finding someone? And then how much is it going to cost me? Can you briefly just explain how someone can go about finding the right person to help them with their finances?
Yeah, absolutely. I think the first starting point, this is just my personal opinion. I'm trying not to be biased because I'm in that space. But I think the first starting point is if you've got family or friends, ask them who they've recommended. Ask them and just ask. Just say, hey, are you working with someone to help you make good decisions with your retirement? And if you find someone that they trust and they're happy, that would be probably my first source.
Okay.
The second source that we always say is go to the internet, right?
Sure. Google
financial advisors. That's what I do for restaurants. That's what I do, for other service providers, be it electricians or be it plumbers or whatever it might be. And then my personal opinion is when you've either found someone that either your neighbor or friend or maybe a relative recommended, or you found someone online, go meet with them. Yeah. Just like your doctor.
There's consults, right? And then
absolutely.
You can decide and you can learn a little bit more about how much it will cost you.
Yeah. And that's exactly right. And financial advisors charge differently. Some charge an upfront fee. Some may charge based on the money that they're managing. Some might charge based on the specific investments that you purchase. So they charge a little bit different, but I would just say this. I feel like this is my space, but I'm very passionate about it, Kamie. And I look at it from the standpoint is a lot of these people that are getting close to retirement, this is what they've spent 35, 40 years building.
Yeah.
And all I can say is take your time. Don't rush into this, because you do get one shot at this and that's it. And so if it means, taking 3 different days and meeting with someone to really understand. I'm a big gut guy. I'm like, if your gut's telling you this person or this firm resonates with you and you're kind of in sync, if you vetted out a couple others and you're like, this is who I feel, then go for it.
Mm-hmm.
But I do think that having someone in your corner that maybe has some of the technology, some of the technology and the software that we continuously talk about, I think can make a big difference.
Yeah. We've talked about the behavioral finance with your emotions. It can help alleviate some of that stress, but also make sure you're doing it correctly and maybe save you some money along the way.
Yeah.
All right.
Great question, though. Yeah.
Yeah. Well, it was a question from one of our viewers. So again, thanks to you for joining us for another episode here of our podcast. Again, you can retire and thrive with us weekly. We have a new podcast drop each week. And if you subscribe to this channel, you can get notifications about each episode that drops. And if you'd like to join in, also, please feel free to share this. If you have a loved one that maybe is in that retirement age and a little bit concerned and worried, drop a link to them of one of our episodes, because that's all we're trying to do here is educate and help others in this process that can sometimes be stressful, but it can also be a whole lot of fun because it is time to enjoy the fruits of your labor, as we have touched on, and enjoy some of that money that you've worked your lifetime for.
Kamie,
well, part of your lifetime.
I've got one question for you, and I know we are butting up against time here.
Yes. What is this question?
Episode 1, you said part of the reason why you wanted to do this podcast was to learn a little bit more.
Yes, I am learning a lot.
That was my question.
Yes.
So we're on episode 10.
Oh,
okay?
yes.
And we weren't sure how this was all going to shake out, but I will tell you this. I'm going to circle back with your question, but this has been a lot of fun for me.
Mm-hmm.
And this is not a sign off at all, but this has been fun for me because I wasn't exactly sure how this was going to unfold.
Yeah.
But tell me, give me in a nutshell, have you learned some things, and what's been your experience in the 10 episodes?
I have learned so many things where I think I need to like jot them down and go research them further, because you mentioned so many different things when it comes to retirement. I mean, it's not really something I've looked at fully. Obviously, I'm working towards my retirement, but I'm in a little bit of a different stage. And so I've learned so much, and it's refreshing because you have a lot of positive stories and a lot of positive outcomes. So that's been fantastic. But yeah, I decided to do this with Dan because A, Dan's awesome, but B, it's just, it's always great to learn about your finances and being more financially literate and learning more. So I've had a blast. Yeah. It's been great. And hopefully it helps me along the way as it is helping you, I hope.
I do know that you did make the comment that money can be very boring. So hopefully this hasn't been boring for you.
It's not boring. It's not boring. I think money more so can be along that stressful line and looking at all that money you're spending and how much money's coming in and where is it going and what if an emergency happens and what do you do in that situation? And then thinking about that in retirement even can be a little bit more scary because you're not sure what the future holds and how much money you have and things like that. But yeah, it's been great. And it helps me relate to other people. So I love it.
Well, thank you for that comment. And again, I was just thinking that in my head when you were talking about one of your things is that you wanted to learn more about finance and money. And as you're well aware of, we've got 7 lessons we've covered. We're just wrapping up 3.
Yes.
So if you learned this much, I'm anxious to hear where you're at here in a few
months.
Yeah.
Yes. It's been really a good time. And I hope that you all have had a great time as well, as fun as we had. We have had so much fun and I've learned a lot. And please drop questions below. We appreciate all the comments, or just let us know what you think. If you think we're doing okay, if you want something different, let us know. We're more than happy to accommodate. All right, that's all from us for now. As I mentioned, I believe next week we're talking about a spending plan. So I hope that you can join us for that.
Thank you.
Thank you. Thank you, Dan. From myself, thanks to all of you for joining us today. We'll see you next week.